What's up, y'all? Today we're talking about taxes and lowering your active income tax bracket. I'm not a CPA. Talk to your CPA about this, but I'm going to give you a couple of ideas and strategies that I've seen work for a lot of my investors who passively invest in some of my projects and invest passively and actively in other real estate projects, and how they've taken their high incomes and their high active incomes on an annual basis and able to knock it down pretty considerably through real estate. So I want to share probably one of the best strategies in the US tax code, the real estate professional designation. Before I even dive into that, it's important to understand that the tax code was written by landowners. So the people who own the land had made the money, who then had the power in the political system to then influence the tax code here. And when you understand that perspective, you realize that there's a lot of incentives and a lot of benefits in the tax code that specifically benefit landowners. So if you are a landowner and a commercial real estate landowner, that just takes everything and amplifies it and scales it up pretty considerably because the dollar sizes are quite a bit bigger. Typically the best codes, a lot of the best codes in the tax code are for landowners and especially rental real estate landowners. So that's the first thing to understand. The tax code breaks up passive income and active income, and passive losses and active losses. So let's say that you have a traditional business and you make $500,000 a year in active income. That active income can be offset by active losses. So typical business expenses and travel and legal and payroll and overhead and all that different kind of stuff can offset your active and earned income because those are active losses. Then you have your bucket of passive income. Passive income is things like interest income, royalty income, dividend income, things along those lines that can be offset by passive losses. Passive losses, for instance, is like something like depreciation. The issue is that if you are a traditional business owner and not a real estate professional, you cannot consolidate these things. But if you're a real estate professional, let's say you're a flipper and you buy and you fix and flip houses, and that's your full-time business, obviously, you can offset your income there by what you bought the property for, your insurance, your taxes, your utilities, and all those operating expenses, your cost of capital, and you can offset your active and earned income with those active losses. And now that you're a full-time real estate professional, if you buy and hold some properties, then you can take the depreciation and the passive income and the passive losses, and the tax code allows you to lump it all into one bucket. So what constitutes a full-time real estate professional? It doesn't need to be where you make the majority of your money, but it needs to be where you spend the majority of your time. From the tax code, it says you have to spend 750 hours a year doing real estate activities, and it needs to be the majority of how you spend your time. So if you have a W-2 income somewhere else, a job somewhere that's not in your own business as a real estate investor and real estate professional, you cannot be a real estate professional. If you're a realtor, that's seen as a sales professional, not a real estate professional. But if you are actively buying and selling real estate, that constitutes a real estate professional. And if it's spending more than 750 hours a year, which is about 15 hours a week of your time, and that's the majority of where you spend your time, even if you have other businesses that generate revenue or maybe even more money than what your real estate business is, you are a full-time real estate professional. Again, talk to your CPA, make sure you feel good about it, make sure your CPA feels good about it, and all those kinds of things. But it's just a designation that you put on your tax return. So let's say you flip houses and you make $500,000 a year flipping houses. If you buy rental real estate and you depreciate that rental real estate, that depreciation, although a passive loss, gets put in the same bucket as your active income and active losses, and you're able to offset a lot of your active income with those passive losses. So let's go through a quick example. You might have heard of something called a cost segregation study. So let's say you go out and you buy a $2 million apartment building. It's probably about 20 units. You buy it for $2 million. You're able to depreciate the building value. Land is not depreciable, but the building value is depreciable. So the land value, let's say you're in the Midwest somewhere, the land value is 10% of what that $2 million is, so about 200 grand. That allows you about $1.8 million of building value to depreciate. Now, if you do a cost segregation study, that essentially goes around the property and says, hey, the tax code allows me to depreciate this over 27 and a half years, but there's certain things that aren't going to last 27 and a half years, like the carpet, like the HVAC, like maybe the roof, like the trim or the molding or things along the light fixtures. That stuff might not last 27 and a half years. And so what a cost segregation company would do is they would segregate out all the different costs that are associated with that building and the value of that building. And there's certain schedules. Essentially, some things can be depreciated in the first 5 years or the first 10 years or 15 years, and you can expedite some of the depreciation. So the government then passed a law that allows accelerated depreciation. So not only do you segregate out the costs and you kind of front end load a lot of those costs in the first 5 to 15 years of your ownership, but the government during the Trump administration allowed accelerated depreciation, which means you could take all of that and put it all into the first year. I think it was anything under 15 years or less could be thrown into the first year. And it ends up being about 25% of the overall value of the building. So on a building that's $1.8 million of depreciable value, you get about $450,000 of depreciation that first year. And it could be more or less depending on the type of the building, the age of the building, and a lot of other factors. That's why you just hire a cost seg company in order to do that. But on average, what I've seen in my own properties is about 25%. On that property, it's $450,000 of depreciation that I could get in the first year. But the way it was written is that it starts waning down by about 20% every single year. So you get 100% in 2022, you get 80% in 2023, 60% in 2024. Next year, 2025, is going to be 40%, and then 20%, and then it goes away. Now, it's on the table right now, and I think the House has already passed it, and Biden has said that he will pass it if it passes the Senate as well, that he would reinstate that. And so it would go back to 100% of accelerated depreciation in this year. So if it goes back to 100%, you've got $450,000 of depreciation that is passive loss, but it goes into the same bucket as your active income and active losses. So if you make $500,000 a year in active income flipping houses, and it gets offset by $450,000 of depreciation, that takes your taxable income, net income, from $500,000 down to $50,000 for the year. So what that does for you financially is, if you're at $500,000 a year, you're in one of the higher tax brackets. I think the highest tax bracket, depending on your state income and all that kind of stuff. It probably blends out to be somewhere around a 30%, maybe more, 35% tax bracket. So on 500 grand, if you're saving a third of that, you would have been paying $170,000 to income taxes. Whereas in this case, if you go and buy an asset, right, the government is incentivizing you to go out and buy assets. That's why they allow us to do these things, because they want investment. As you invest, you pay more property taxes. As you invest, you create more jobs. As you invest, there's a lot of other different things that the government benefits from outside of that. That's why they would allow you to depreciate and offset your active and earned income taxes this way. So by buying a property, you're able to take that 170 grand and you would have paid it out to the government. Instead, you're able to save that money and put it into an investment in a new deal, right? So it incentivizes you to go out and make these additional investments, and it benefits you because over time, those rents are going to grow. Over time, you're going to pay down the principal balance. And over time, you're going to find yourself sitting on a bunch of equity in this $2 million building that you bought this year. And in 25 years from now, it'll be paid off free and clear. It'll be cash flowing like crazy. It'll probably double in value. It'll do around $4 million, $5 million in value. And it'll increase your net worth pretty considerably. That's the beauty of doing this. And the entire time, you're able to depreciate, right, that property value and offset a portion of your active and earned income. All right, so that's if you are a full-time real estate professional. If you're buying and selling real estate, you are a full-time real estate professional, and you can utilize the tax code to benefit you in that way. Now, what happens if you have a traditional business? Let's say you're a white-collar professional, you're a dentist or a doctor, or you have a traditional business in e-commerce or a brick-and-mortar store, you own a bunch of restaurants. How can you benefit from this? So what I've seen done is, let's say somebody makes $2 million a year in their active and earned business. And they don't have the tax breaks, right? They can only offset, even though they're a business owner, they can offset their income with active and earned losses, but not with passive stuff. Unless your spouse, who's married filing jointly, is a full-time real estate professional. So if your spouse is a full-time real estate professional and they are flipping properties or they own some rental properties and you're actively investing through them and their entity, they are a full-time real estate professional taking their depreciation that they get on an annual basis combined with your active and earned income. Because you're married filing jointly, their depreciation can now offset your active and earned income. So it all of a sudden gets you to a point where, like, I have a celebrity friend. He's like, dude, I'm making way too much money and I'm paying so much in taxes. How can I utilize real estate in order to help me out from a tax perspective? His spouse doesn't work and has a real estate background and has a degree actually in real estate, but doesn't necessarily work. I was like, well, obviously talk to your CPA, but from my understanding, you could put a real estate investment company together that your spouse is the majority owner of, run all the real estate investments through them. As they go out and buy property and accumulate depreciation from those properties, you're married filing joint taxes together, that depreciation can offset your active and earned income. And it allows you to then go and invest in more real estate, create more jobs, pay more taxes, property tax, all those things, and reduces your tax liability on your active and earned income tax bracket. So there's that benefit, which is a huge, huge gain if you understand how that can work. So this video is not meant to be tax advice. It's meant to stir up some conversations. If your CPA is not having these conversations with you, you need to bring these conversations to them and ask them these things. If they poo-poo or shoot it down, find another CPA, because there's a lot of different ways that you should be asking progressive, future-looking questions to your CPA. They should be bringing these ideas to you as opposed to you bringing those to them. But there's a lot of different ways that you can figure out in order to reduce your taxable income by investing into real estate and commercial assets. So if it's not something that you've looked at, make sure you look into it. Make sure you talk to your tax professional about it. If you need some references on awesome tax professionals, I'm happy to introduce you to a couple of folks. There's a few in Legacy Family, which is my mastermind, who represent a lot of real estate investors, a lot of traditional business owners who would actively and passively invest in real estate. And so if I can be a resource for you and make some introductions, don't hesitate to reach out, and I'm happy to make that happen for you. So as you can see, my 1-year-old is outside screaming and squealing and having a good time. And so I'm going to wrap this up. I appreciate you being here. Hopefully you got some good takeaways. If you have any questions, any comments, please put it in the comment section below. And if you do me the favor, just like and subscribe to the video. I love making these videos for you, and hopefully I'm providing a lot of value to you. And just if you can like and subscribe, that provides a lot of value to me. So I appreciate you. I'm going to go play with Annabelle.